I want to welcome you to this webinar. We're going to be talking about some very interesting stuff. In this case, we're going to continue on our discussion that we had during our last webinar, which is the first one I did for FX Street, and that was just basically choosing a Forex broker. And choosing a Forex broker is important in general, but it's specifically important if you're an active trader. And now active trader has many different definitions, so we'll get into what that means. But this is going to be a little bit more in depth, a little bit of a continuation about choosing a Forex broker if you're an active trader. And this is a very important webinar. Now down the road we're going to have other topics, but let's get this broker stuff nailed down right now and really talk about this. And we'll just get right into it here. So first, I'll give you guys a few minutes to get over risk disclaimer. I mean, basically, I hope you all know. Forex trading does have its risks and rewards. So it's very important to know that you could lose your money when trading Forex. You can lose a lot of your investment or all of your investment. So take a few minutes to go through this real quick, and we'll get right into the body of the webinar here. All right. So real briefly about us is we're an introducing broker in the Forex industry. Probably about a little bit over 20 years of Forex experience Forex trading experience between our staff. Basically, our main goal is to maximize your success by A, matching you up with the best broker for you, and B, setting you up with cash bonuses. So and enhanced customer service. We're located in Newton, Massachusetts, right around Boston area in the United States. So let's get right into the body here. I don't want to take too much time talking about us. Let's talk about what an active trader is. And an active trader has, there's many definitions, but for the sake of this webinar, basically, we're going to consider an active trader someone who does a lot of volume, so high volume on a monthly basis, or someone who deposits a lot of money into their account. Now, obviously, an active trader is more volume related, but there's certain specific perks that you can get by depositing a lot of money and doing high volume that you couldn't get if you don't do either one. So maybe an active trader is not the perfect definition here, but basically it's a big trader, it's a big client. And when you're a big client, there's certain things that you got to watch out for. There's certain things that you got to look for, and there's certain perks that you can get which you couldn't in another way that can enhance your trading success. So keys to success, and these are the things that we're going to be looking at for an active trader, is number one, protect your funds. I think we said this during our last webinar here, but protecting your funds is essential to your success. You could have the best execution in the world, and I see some of these brokers out there, smaller ones, that, they say would pass all the, there's like non-profit ones out there, they say would pass you the direct feed, and you're seeing a 0.1 pip spread or something like that, and, all you pay us is a little commission, or a monthly subscription fee, but at the end of the day, who's holding your money? That's the thing that you got to think about. Who's really holding your funds there? So even with the tighter spreads and the great execution, some of these are giving away 20% deposit bonus. It's all good until you want to take your money out of this place and the money is gone. You need to make sure your funds are protected, and I will tell you what to look for to make sure that your funds are protected. Honestly, unless certain minimal level of a criteria is met, as someone who does a lot of volume or someone who holds big deposits, I wouldn't even look at a broker unless a certain minimum criteria is met, and we're going to tell you what this criteria is. Fair execution, and I guess 2 and 3 kind of go together here. Tight pricing and spreads and fair execution. These are basically your trading conditions, and obviously you want to make sure that your trading conditions are met. You want to know, if you're doing this on a high level, you want to know your system, and you want to know what you need with your system in order to be successful. For example, if you're trading on the news, you're trading the second the news comes out, for example. You need one-click order execution. If you're doing short-term trading, scalping, real short-term trading, that's what a lot of active traders do. One-click order execution helps. And these are the features that you want to make sure that you can use, that your platform can handle in order for you to be able to trade successfully. So it's very important to take your system, figure out exactly what you need, and then contact your broker or your introducing broker, and make sure that the dealing firm, that your counterparty, is going to be able to facilitate those needs. So that's something that you want to pay attention to. And then, like I said, in my last presentation and a little bit earlier here today, basically Forex industry is very competitive. There's a very, very high profit margin for brokers and for introducing brokers. And it's like nothing else. That's it's not, there's not too much out there right now that is as profitable for trade facilitators as Forex is. And for this reason, basically, people compete for your business, and brokers can compete for your business more so than stockbrokers, for example, could compete, or than futures brokers, because forex brokers just have a lot more margin to play with. And I'm not talking about trading margin, I'm talking about profit margin. And for this reason, you can get huge bonuses. You can get deposit bonuses. Like I've seen bonuses even by big stable firms up to 10%. And that's tremendous. I mean, imagine opening an account being up 10% right away. So that's a 10% match. And then you get your trade rebates, which is something that certain introducing brokers offer. I mean, I know actually FX Street has a program with trade rebates. We do, and there's a bunch of other ones. So it's something to pay attention to as well. So let's talk about the safety of funds here. So basically, like I mentioned, before you look at anything else, and I mean, when you're choosing a broker, you got to know your system as an active trader, and you got to know you got to start at a checklist. So before you look at anything else, spreads, execution, perks, anything of that sort, first thing you want to look for is the safety of funds. How safe will your money be? Meaning, let's say you do real well and make money, that you'll be able to pull it out whenever you want. Let's say you don't make money, but you have some left, you'll be able to pull that out whenever you want. So the safety of your funds is the most important thing. And basically, you want to trade with a very large, reputable broker. And first thing that you can do is you got to know about what a segregated account is. Now, I mentioned this during our last one, but I'm going to recap it right now. And a segregated account, basically, when you set up an account with a U.S. broker, there's a term called a secured creditor and an unsecured creditor. In certain cases, with most U.S. brokers, you're an unsecured creditor. That means that if a company ever happens to go into a bankruptcy proceeding, basically goes out of business, you're actually not going to be the first in line to get your money back. The creditors will be first in line, but you will not as a futures trader with a U.S. broker, you will, but with a forex trader, you will not be first in line. That means there's going to be a little bit of lag before you get your money back, or you may get back a portion of your deposit. So you may get back 80 cents on the dollar or something like that, or 50 cents on the dollar. Now, I've seen a ton of companies, smaller companies in the U.S., go out of business, and their traders were in limbo in terms of getting their money back. And in certain cases, they got back like literally 40 cents on the dollar. So what that means is, say you had funded $10,000 account right before this company went out of business, you would get back 4,000. Probably be happy to do that, because some companies, these people didn't even get their money. This is not just U.S., this is all over the world. There's certain countries that allow you to have a segregated account, which is what the first bullet point talks about. And I'm going to mention that in a second. But I mean, just so you know, we recommend, U.S. is a very safe place. It is a good place. But there are companies, don't think that just because a company is in the U.S. means you're fully protected. Forex Liquidity, for example, FXLQ was the name of the company. They were a U.S. dealing firm. Big issue. Customers didn't get their money back until they got bought out by another firm or something like that. But they had a margin issue. They got shut down, and it was just there was just a period where everybody's money was in limbo. There's another company here called CFG. Same thing happened. Customers had an issue getting their money back. UGM here in Boston, same thing. Refco, that wasn't a U.S., but that was, you guys probably remember that one. Refco was, it was a while back. I think it was right around 2005, but that was a huge one. All kinds of customers. I think people are still yet to get their money back. So these are the things that you want to pay attention to. So do I have a segregated account? Now, one thing is that many of the big U.S. firms like Gain Capital, FX, and FXCM, they have an office in the UK. So they have a branch of the company in the UK, and it's actually a separate entity located in United Kingdom. Now, United Kingdom is regulated by the FSA, called the Financial Service Advisor. And basically any company that's set up in UK, you have a segregated account, which makes you a secured creditor. Secured creditor means that you're going to be first in line in bankruptcy proceedings. So if there was ever an issue with the company, they would have to pay you back first before they pay back creditors and things like that. So you'd be first in line rather than last. And this is very important. Now, the other thing with the UK, and I don't want to get into the technicalities here because, you know, it's just a lot of stuff that you guys don't really need to know the details of. But basically, and I don't want to say something incorrect either. I mean, I'll be honest with you. But basically, you have a little bit of a better chance too, where your account it's not quite insured like a bank account, but it is protected. I believe it's up to 35,000. It is protected. So if there was ever an issue, there's some kind of a bond or an insurance policy that gives you an additional advantage. So up to 35,000, you're like really, really well protected. I'll put it that way over there. I mean, obviously there's still some risks. I have to say that, but much, much more protected with the UK than anywhere else in terms of this stuff. So that's the benefit. That's the segregated account. And, I mean, the gist of it, layman's terms here, you get more protection with a segregated account. You can get a segregated account through a UK broker. Big US firms such as Gain UK, FXCM, big US firms such as Gain Capital, FXCM have a UK branch. Okay? Now, the second item here is you want to trade at a large broker, right? So we just mentioned those two firms, Gain Capital and FXCM. And really, the thing is that bigger is better in the industry. And one place that you could go to, and I'm not sure why we don't have the link up here, but if you guys contact us, we'll send you a specific link to this, is the CFTC website has a listing, and in our last presentation we had a link, of every single firm, that U.S. firm, and how much money they have, how much capital they have, net capital available. And obviously the bigger ones are the safer firms because they have more money. They're less likely to go bankrupt because they have more funds on hand. And you know, if a firm has a lot of money in the U.S. and they have a UK branch, it should give you an indication this is a big firm. You know, it gives you a stability of, like an indication of their stability. So it's very important to pay attention to that. And I mean, you know, obviously you're going to have more safety. The firms that went out, I mean, Refco was a special case because Refco was big. But since then, Forex Liquidity, CFG, TradeX, these are just ones that are coming up the top of my head. UGM, those were all small firms. So, you know, there's one big one, but four small ones for that went down. And definitely lack of size is a warning sign by all means. You know, it's just how it is. The other thing that you're going to find out is that the bigger brokers are going to be better operationally, and that's very important too, because that's the other thing is that when you got one person going on a small firm, going through and setting up all these accounts, and then you're right in the middle of your account, and the guy gets sick for 2 weeks, you got a problem. Things can get lost. I mean, I remember we obviously, you know, took us a while to get experience, and now we only really work with the biggest ones. We work with FXD, Gain Capital, FXCM, you know, sometimes MP Trading as well. But they're all big, solid firms. You know, what happens is their operation is sound. When we used to work with these smaller firms, operationally it was a nightmare, and you know that's what we learned. Stay away from it. Doesn't matter if they claim to have more fair execution or if they claim to have you know, tighter spreads. It doesn't matter. Let's make sure the firm's operation is sound. So I mean, the big ones are once again like Gain Capital, FXCM, FX Solutions is good. We work with them too. FXDD, MB Trading, those are solid firms. So now the next thing is basically is your TradeX. So I'm going to start with the last bullet point first. And as a big trader, as an active trader, I'm sure you have a trading system in place. And this could be a trading robot. It could be trading on the news. You could be scalping. You could be swing trading. You need to really map it out, and you need to know exactly what type of orders. And you got to think of it from an order execution standpoint. So let's say, you know, you have a semi-manual system, and there's just one out on the market, like the scalping system. I mean, when I say scalping, you're in trades for maybe between 30 seconds and 3 minutes. So just really short-term system. And you got to think about it. Sit down with a piece of paper and a pad and think about what is it that this is going to require me to do from a trading perspective. So I want to be able to get in with one click. For example, I'm just using an example here. I want to be able to get with one click, stay in the trade for between 30 seconds and 3 minutes, and get out with one click. And I don't want delay on my way in. I don't want delay on my way out. Okay, so this is my criteria. So now you need to go to a broker or an introducing broker. An unbiased introducing broker may be the best bet. And say, this is what I need, right? What do you guys think is the best place for it? Okay? So, basically, first map out exactly what you're going to do, and then map out then look at it from an order placement, order execution standpoint, and see if your broker can accommodate you. Now, there's a while back, I'd say maybe this was around 2006, and everybody was saying these brokers are so bad, they're messing with us and blah blah blah. And it was a lot of these news traders. And until finally I got some experience. I guess at that time I still wasn't really understanding what they were talking about, but everybody was blaming the brokers. These brokers are so horrible. They're trading against you. They can't fill our orders. They're delaying us. They're stopping us. Well, now that I looked at it, not now, but a little bit into it, I looked at it and I realized what these people were doing. So what they were doing is they were basically trading on the dead price. They would have a fast feed in place. They would wait till a news announcement would take off in one direction. The broker would be still yet to catch up, so they would take advantage of the fact that the broker's price got stuck during that quick spike during the news and place the order on that dead price and then hope to get in on that dead price and get out after the price is caught up to the real price. It's basically, it sounds a little complex the way I'm explaining it, but basically what they were doing is they were trying to get in on a price that wasn't there. The price was already moved, and just the only issue was that the broker's price feed did not catch up. If the broker's price feed was not slow and would have moved fast, their opportunity wouldn't be there. They were taking advantage of a glitch of a broker, and essentially taking advantage. I don't want to say cheat because if it works, it works. It's trading, you know what I mean? But they were trying to take advantage of a glitch. And if the glitch is there and you can take advantage of it, and some brokers are to a certain extent okay with it. If they get decent trading volume and then you take advantage of them on a couple of news announcements, they're okay. If they get a good volume from you and it's an overall good thing. But if you consistently just basically taking advantage of them, it's not going to be good anymore. Bottom line is these people didn't talk to the brokers. They just went in and they tried to cheat. And then they blame the brokers, saying these brokers are so bad, they're not letting us in, things like that. Well, if they came in up front and said, this is my strategy, this is what I'm doing, will you be able to accommodate them? A broker, and I've seen it done, they would say, no thank you, we don't want this kind of business, try to go somewhere else. They may even give you a recommendation of where to go. Because some places can take that volume, but some places cannot. So what that means is you want to know your system, you want to know exactly what you're going to be doing, and you want to go to your broker or to an introducing broker and tell them, okay, I'm going to be trading I'm going to be in and out in 10 seconds. Can you handle that? Some places will say yes, some places will right away outright say no. And let's say you got 10 brokers to choose from, right away you're going to know 10 that maybe you will know 3 or 4 that you just don't want to deal with because they straight up themselves told you. They're not bad guys. I mean, the way their model works is it works, but is a fair way in many cases, not in all. But the problem is that you don't want to try to take advantage of them and then say that they're bad. So you got to come up to them up front and say what you're going to do. Bigger is better. Once again, I'm going to the other bullet point now, and this theme really carries through. Is that bigger is better? The bigger the firm, the more likely they'll be able to facilitate your trades because they have deeper lines of liquidity and they have more people in their system. So the bigger is absolutely better. And that's basically it in terms of knowing your system. Now, a big one, and the thing that comes up a lot, and especially with active traders, the thing that comes up a lot, and especially with active traders, is they want the ECN or the straight-through execution, and they don't want the DealDesk. And this all comes down to, once again, to knowing your system. Okay? Now, basically, let me just give a quick run-through about how a dealing desk works and how an ECN works. Now, remember, in the first step, we eliminated all the smaller firms. The smaller firms have a very different way of doing things. And we don't want to you guys don't want to trade like that. You don't want to trade with a firm that'll do it. Because yes, there are some firms that'll be sitting there and trading against you, and the moment you start making money, they'll want you out, they'll start messing with you. I've seen it happen. But a big dealing desk doesn't look at it that way. A big dealing desk, everybody is essentially a market maker, and they're making the money. So what that means is everybody's trades comes in, and the firm is accumulating those trades. And basically, what they're doing is they're looking at the net position of the desk in itself, of the market maker in itself, and they're hedging off their net position. So they're not actually sitting there. I mean, you got to think someone like FXCM or someone like Gain. I mean, they probably have 50,000 clients. They're not sitting there and trading against each client individually. It would be crazy. It'd be crazy. It would be impossible. What they're doing is they're accumulating the net position, the trades of everyone, and hedging off their net position. It's called a delta hedge. Okay, this is not so bad because there's market makers everywhere. I mean, man, there's market makers on the New York Stock Exchange, for example. There's market makers in all kinds of trading arenas, and it's not so bad. In some cases, they'll notice that a trader is good, and that's only a good thing for them because they can trade with the trader. And actually, the desk will execute your order and they'll follow you. So it does have its advantages. You don't have that anonymity factor, and we'll talk about that in a second. The anonymity is good from one standpoint, but it may not be so good from another. You know who you're dealing with. So what that means is you know who you're dealing with. So if there's ever an issue, there's a problem with the trade, you call the deal desk. And I've seen many times where the market, a firm that makes the market was able to correct the problem, where an ECN could not because they don't know how the trade got facilitated, and that's it. They're like, yeah, we're just a technology company. Now, in ECN, or there's other types. There's an agency model and STP. Basically, what an ECN is trades are coming in, and the first thing that an ECN will try to do is match you up electronically with another entity or person that's trying to go in the opposite direction. So you want to go long one lot of euro US dollar, it'll match you up with someone who's trying to go short electronically, and they'll just take the transaction fee. If it can't do that, it'll offset your trade to another liquidity provider, which is essentially another market maker. The big difference with the ECN is you have anonymity. So the liquidity provider doesn't know exactly what you're going to be doing. So if you're going to be trying to trade, for example, on the news or do something that's somewhat predatory, you may be better off at an ECN because you have anonymity. So that's really one big benefit. Sometimes the spreads are going to go down, and one other cool thing with an ECN is you can trade in between the spreads. So you can make your own market. You put your order in between the spreads, kind of like you can do with stocks at some point. You put a limit order in between the spreads and see who takes, because you can. That's another advantage. STP models, they won't match you up, they won't try to match you up internally, and they'll pass you up right to the liquidity provider. So that's another type of model, and all of them can work as long as you have a big, stable, operationally sound firm. So that's the thing that you guys may want to jot down. Safe, big, stable, operationally sound firm. B, come to them with your strategy and ask them if they can accept it. A DealDesk may accept certain things, an ECN may accept certain things, and any other kind of model may accept certain things, and they may not want certain things. I mean, I've seen ECN and CurrentX models reject certain types of traders. Happens all the time. So it really depends on your strategy, but the big thing is come to them up front. Don't try to cheat, because if you do, that's when you're going to run into issues as an active trader. And don't just talk to one guy, because when you talk to a sales guy at a firm, a lot of the time they're going to be like, yeah, I can take it all, and they just want to get the money in the door. They're probably getting paid somehow on deposit, so let's get the money in the door of the company, and then we'll deal with it later. Well, don't talk just to one guy. Talk to first thing you want to do is you want to talk to you either call a company or you call an introducing broker. Like, for example, such as us, we help people find the right dealing firm for them. Or there's other ones out there. Talk to them, read some reviews about it. Then talk to one guy, talk to another guy, talk to another guy. Just, you can even pretend you're somebody else, when you're calling in, and get a consent. Okay, these guys can definitely take it. And one guy says they can, and then another guy says they can. That's questionable, right? So it's very important to come to them with your strategy. Come anonymously. You don't have to, there's nothing out there that says you have to give you all your information and see if they can accommodate it. So that's basically the situation there. The other thing is, for your trading style, figure out what platform do you need. Do you need a specific type of orders? Do you need a one cancel outlet, OCO order? So with a stop and a limit on both sides of the trade, and then once one is triggered, the other one's canceled. Do you need one-click order execution, right? Do you need bracket orders? So when you get in, placing a stop and a limit on your trade. Do you need multiple limit orders? I mean, there's certain things that one platform can do, the other platform can't. Are you doing technical analysis? Do you need to trade on the chart? All these things are very important to take into consideration. And for that, you got to really know your trading strategy. Once again, calling a broker really is the best way. There's a bunch of platforms out there. I mean, each one has their own advantages and disadvantages. Some are better for beginners. Some are better for advanced traders. I mean, with the MetaTrader 4, for example, you need to do semi-automated stuff. So that's what MetaTrader 4 is all about. A platform like Trading Station with FXCM, one-click order execution is real good right there. You get your box, you get your price, and that's it. So there's a bunch of different things to choose from. Once again, there's no better way. I mean, I could get into the detail of every single one of these platforms, but there's really no better way than finding out specifically what you need and then finding the platform that'll match your needs. It's a much better way to look at it than learning about every single platform. And, there's a ton of resources out there. The FX Street is probably one of the biggest and best resources out there for you in terms of finding a broker. Let's talk about pricing. And as you can imagine, we said active traders either big deposit or big volume, right? So as you can imagine, spreads drastically add up on big volume. I mean, just think about this. Let's say you have a $20,000 account, right? And you're going to do 100 round turn standard lots per month on a $20,000 account. And the spread is 2 pips. That means you're paying $2,000 in spread, which is 10% of your account. Now, the smart trader, naturally, you understand that. That is a lot to pay. I mean, that is a lot of ground to cover. In order just to get back to even, you got to break 10% of transaction costs. Transaction costs in Forex are big. Don't get, that was one of the things that, and I think I mentioned this on my last webinar. But transaction costs in Forex are big, and brokers may lead you to believe otherwise. Not the case. It really, really does add up. I mean, that's not unreasonable to trade 100 standards on a 20K account. We see it all the time. And you're putting yourself down 10%. So you got to make up 10% just to get back to even. Now, as a big trader, you obviously want to bring that spread down as much as possible. It's essential, really. So how do we go about doing that? How do we bring the spread down? Basically, to minimize, to take that cost at least down from 10%. I mean, if you can even get it to 5%, to 7%, I mean, everything adds up. If you can make 3% a month, you're making 36% a year. That's fantastic. You know what I mean? That's, as a smart trader, I mean, naturally understand that that's a lot. So even saving yourself 2 or 3%, I mean, essentially just tremendous. So now, as a big trader, as a high volume trader, you may not have to necessarily trade on the spreads that are offered by the firm. There are tighter spread structures available. The only thing is you got to figure out what makes the most sense. Does it make sense to go in a tighter spread structure, or does it make sense to get yourself a repeat? Because it's different in many cases. So what you want to do for starters is you want to look at all the different pricing structures. And many firms will have it. Like, for example, Gain Capital has this little indicator, the 20-day moving average of the spread. So when you're looking into the firms to trade with, you may want to ask them, okay, I'm trading the pair, let's say it's the USD yen. What's your 20-day moving average of the spread for all your spread structures? This is a good question to ask the firm. So let's say you narrowed it down to 2 firms, Gain Capital and FXCM, right? Call each one of the firms up. What's your 20-day moving average? The thing on their website, it says as low as, right? And you know what that means, right? It's like it's as low. Like so let's say for 1 second during the day it gets down to that, and they'll just do it on purpose just so they can say as low. And let's say it gets down to 0.9. They'll say spreads as low as 0.9. Well, it doesn't really do too much good for you, right? If it's there for 1 second and the rest of the day it's 2.5 or something. So as for the 20-day moving average, they should be able to provide it. Really insist. And they may have different spread structures. So ask for the 20-day moving average with each spread structure. Now, some of them will have a commission-based model. So you make sure, don't just look at the spread. You want to add the commissions back in. Here's another big thing to take into consideration. Is the commission that they have, is it in base currency or is it in USD? What that means is if the commission is in base currency, then let's say it's a $5. Let's say for simplicity's sake, it's a $10 commission per round term, which is a little high. I'm just using that number for simplicity's sake. So if it's $10 per round term base, it's $10. So let's say your average spread is 1 and your commission is 10. Your total cost is 20, right? 1 pip is $10 and $10 commission is $10. So your total cost is 20. But if the commission is in USD, right, then you have to multiply it times the cross rate if the other pair is on top. So the non-USD pair is on top. So if like, for example, Euro USD, and let's say Euro is around 1.25 right now, right? So you would multiply that 10 times 1.25, so it's actually 12.50. So then if you see a 1 pip spread and a $10 USD commission, you would multiply it times, so your total spread would, your total cost would be 22.50 rather than just $20 or 2 pips. So this is something that you want to take into consideration. So you want to look at your total cost or your total spread using this 20-day moving average spread model over specific, for each different spread rate, spread structure that they have, pricing structure that they have. There's the standard one. There's their, if they have a reduced, and then they even have sometimes 2 levels of reduced. The other thing is that moving average rate. You can also ask, and in some cases, like I know with Gain Capital, they can do this. You can break it down by time. So let's say you trade during the Asian session. What's your average spread during the Asian session? And they should be able to dig this up for you. I know a good introducing broker can dig this up for you as well, because that's very important. What are you going to see? If their average spread is low, but it's only low, it's extra low during the European session, but it's bad during the Asian, and you're trading during Asian, that low average spread doesn't really do anything for you. So that's something else to take into consideration there. And now you want to look at all these and compare them and find what you like best. But remember the trade rebate. And this is part of the active trader perks, but I'm going to skip the slide and I'm going to go back to here. And I'm going to talk to you about the trade rebates real quick. And many companies offer trade rebates. We're one of them. FX Street is one of them. There's a bunch of them more out there. But what a trade rebate can do is, for example, you want to look at, let's say you look at your standard pricing structure. Companies can pay you back up to 0.7 of a pip, sometimes 0.8 of a pip on one standard lot trade. And that essentially, depends on your volume, of course. It would be a high volume. I mean, it goes anywhere from from 0.2 to, 8 or 9, depending on your volume. And what that could do is that could drastically lower your spread. So, for example, if you're seeing a 2 pip spread and a company is able to give you a bonus of 0.6, 0.7 of a pip back on your trade, then your spread is actually 1.4, which may be better than the tighter spread trading structure. The way this works is basically that the dealing firm pays an introducing broker to refer business in rebate, and then the introducing broker passes a portion of that back to you, the trader. And this doesn't cost you guys anything, and it gives you basically free money and reduced prices to put in your pocket. And as an active trader, this is one of the big perks. So we're going to move right on to the next section in terms of perks. This is going to be one of the big perks that you can get. Definitely going to get enhanced service. I mean, a lot of these companies, like FXCM, have gold trading or platinum trading packages available, which gives you more charting, more resources, more research, better direct person to call, things like that. So you can definitely call in as an active trader and get these things. You get tools, like I said, a lot of research, VPS robot hosting, certain types of trading signals, market analysis, and then most important, cash bonuses. I mean, when a person comes to us and it's over a certain amount, like over 30 or 50,000, it's like they say, it's ad hoc. You know what I mean? It's not one of those things that's set in stone. But if you ask, hey, I got a $50,000 account, come to any broker really, and ask, I got a $50,000 account. What type of a deposit bonus can you give me? You're most likely going to get at least a 3%. Now those type of match bonuses are tremendous because, like I said, Forex is the one place that can really do them. And think about it, it's a huge jump start on your trading to be up 3% on your account. I mean, an average trader makes what, 20% a year? Well, not saying an average successful trader. Most traders you know, most traders don't get into the positive. There's very few that get into the positive in general. But the ones that do, I mean, 20% a year is a very good result. Very good result. So imagine getting ahead by by 3%, getting a jump start of 3%. That's tremendous. The trade rebates we just talked about. They'll also, as a big trader, they'll waive all sorts of wire fees for you, things like that, if you ask. So these are the things you want to ask, and you really, if you're coming in big, you want to get all those perks. And I love it how some people say, they say, I'm going to just make my money trading. I don't need any of the free stuff. I like to earn my own money. Well, it is earning your own money because making money trading is your profits minus your costs. So does that mean if you're going to make your money trading, if I raise your spreads by 3 pips, we mark them up and we take them, are you going to be okay with it? No. If you have resources, if you have an ability to lower your transaction costs, do it. Every single penny adds up, believe me. Every single wire fee, every single transaction cost, the swap rates, all that stuff adds up because those are your costs of doing business. And those costs, believe it or not, are what put most traders at a disadvantage. So if you can minimize those costs, you can maximize your advantage. So basically the gist of it. Now, one slide that we wanted to add, and this is you can also trade for your friends and family and even investors. You can use it with it's called a master account. And what a master account allows you to do is it allows people to open up accounts and, because we expect active traders, this is the reason we put the slide in, to be, to be really into it. And they may want to trade for their friends and family. And basically what it allows you to do is everybody will open an account with the dealing firm and you'll get power of attorney over this account. And we'll have a whole webinar about this later on. And this will allow you to trade for them just from one platform. So you don't have to go trade each account individually. You will have a master and this controls all the sub-accounts. I'm not going to get into this too much, but basically all the profits and losses will be allocated on a percentage basis. And then you can charge them various fees. We're going to have a whole separate webinar about this as well as about a lot of other very exciting stuff. But we're just going to leave it at that. I hope this information was helpful. I thank you guys again very much for attending this listening. I hope I was helpful. There's any questions that come up, feel free to contact us. There's a special page that we made just for you guys, it goes into the basics in terms of choosing a broker, and then it goes into some of the more in-depth stuff like ECN, trade execution, things like that. But here's the link you want to go to. It's traderschoicefx.com/broker review and then the number 5. Broker-review and then the number 5. This link, you go in there and you fill out a form and you get our broker guidance. It's going to go a lot more in depth about what the stuff that we just talked about today. Today we're going to talk about the safety of funds. We're going to talk about order execution, and how to get different perks. So once again, let me just give you guys a second to take a look at this link. And here's our contact information. Any questions that come up, feel free to call us. You want to contact us through email. There's a little contact form for you to fill out. And guys, thanks again. Hey, as I always say, I look forward to doing more webinars. We're going to have great topics down the road. Risk management. We're going to talk about trading for your friends and family. We're going to talk about different trading strategies, long-term, short-term, things like that I've been able to pick up through my, I have over 10 years of experience trading and being in the industry really in depth for a long time. So I've seen a lot of traders. I've seen what they do. So we're going to have a lot of great webinars down the road. Also, we're going to talk, but what I always like to do is so I can make them fine-tuned to your needs. I want to make sure that you guys come out of these webinars with feeling like you've been really, like you benefited. So any type of feedback you want to provide me, I feel like I've been talking too fast in this webinar. So if you want to say, hey, Alex, slow down your talking, please send that over to me. Anything else, positive, negative, say, I love the webinar, it's been great. I greatly appreciate it. Just send it in through the contact form. Any type of feedback, any things that we could change for further webinars to enhance your success and enhance your satisfaction level. I'd greatly appreciate it. I thank you guys very much again for attending, and I look forward to working with you more and helping you improve your trading. Thanks again.